All right, of course, we're covering the October jobs report all morning long. The U.S. added 261,000 jobs last month. The unemployment rate at 3.7%. For more on everything jobs and the economy, let's bring in Heidi Shierholz, the Economic Policy Institute Senior Economist and Director of Policy. Good morning to you here, Heidi. Your take on these jobs numbers.
They show, these jobs numbers show an economy that is slowing, a labor market that is slowing, but that is still strong. So, we added 261,000 jobs in October. That's a really strong number, but it's down from more than twice that in the first quarter of the year. Wage growth, if you look over the last 3 months, it's 3.9%. That is much slower than we saw earlier in the year. It was around roughly 6%. So it is, we are still seeing strength, but softening.
If you're the Fed, what do you look at within this report? Do you give any type of weight or extreme weighting to this report?
If any policymaker knows that they have to, any 1 month is not something that you want to look at. You want to look at the longer run trend. And so I know that's what the Fed will be doing. And when you look at the longer run trend, what you really see is an economy, a labor market that is slowing. I know that they will very closely watch the overall number of jobs being added and the wages that workers are getting. And in both of those cases, still strong, but slowing. The wage growth in particular, if you look over the last 3 months, 3.9% at an annualized rate, that's just not a very inflationary number. So that should be good news for the Fed.
I'm so glad you brought up wages because it's not an inflationary number, but it's also not enough for people to keep up with inflation, at least in theory, right? For what all of the higher prices that they're paying. If you look at the inflation adjusted number, real wages, it's pretty lackluster here. So what does that imply then about the vulnerability of Americans going into what is probably going to be a recession?
That is a really good question. So we want workers to be seeing real wage growth in the long haul. Like that is extremely important. Right now, it is also important, particularly given the direction of the Fed, that we start to bring wage growth right now more in line with an economy that is not inflationary. So it is that double-edged sword where we really need workers to see real wage growth over the long run. And because the Fed has the power to really slow the economy, we want to make sure they're getting the signals that they need to know that they don't need to put on the brakes in the way that may, as you noted, cause a recession. The raising interest rates, it's a very blunt instrument. They actually may have already sort of secured a recession in coming months. We don't yet know. One of the things that will be really important, and as you sort of alluded to, is if we do hit a recession, if we do hit a big slowdown, it is workers living paycheck to paycheck who are the ones who are the most likely to lose their jobs. So policymakers will really need to step in and make sure they are okay. They have the support to make it through any kind of slowdown or recession.
Part of the wage conversation, too, is that if businesses continue to incur higher operational expenses or higher expenses due to wages as well, and just making sure that their staff is compensated at a time where they might be halting some of their hiring practices, some of that hiring could not just get frozen, but also lead to separations more so as well if the businesses themselves are not seeing the revenue come through to maintain profitability in order to retain those employees and continue to invest in them too.
Yep, that's right. That you just sort of described what may happen as the economy slows. That, if we slow demand for goods and services, who provides goods and services? Workers. And so if there's slower demand for goods and services, workers may lose their jobs. So we're hoping that doesn't happen en masse, but we'll see how that unfolds. One thing I do think that's important to note is that wage growth actually has not been a key driver of inflation over this, in this recovery. You can actually break down the what's driving inflation into three main components of costs. So basically all goods and services in the US can be broken down, the cost of it can be broken down into labor costs, which is wages and benefits, non-labor costs, which is like equipment, materials, and corporate profits. In any given period, you can look at what is the contribution to inflation of each of those three things. And if you look in this recovery, in the recovery from the COVID recession, wages explain just about 20% of the rise in inflation over the last period, whereas corporate profits explain about 40%. So when the Fed really wants to look at what's affecting inflation right now, it's really important to look also to corporate profits.
Heidi Shierholz, Economic Policy Institute Senior Economist and Director of Policy. Great to have your energy here on the show with us this morning. Look, if you play any sports, I'm always looking for people to add to the team. I love that energy. Thanks so much for joining us here this morning.